477%. According to the Justice Department, that is how much FTE Networks overstated its accounts receivable for fiscal year 2016. That's the money its customers supposedly owed it. And 2016 was the worst of it. For every single quarter of 2017 and 2018, the same company overstated the same line by somewhere between 18 and 120%. The same Justice Department release carries the ending. On September 25, 2025, the company's former chairman and chief executive was sentenced to 12 years in federal prison. His chief financial officer had already been sentenced. FTE's own filing with the SEC puts David Lethem at 48 months. FTE Networks was a publicly traded telecommunications company. Michael Palleschi was its chairman and chief executive. David Lethem was its chief financial officer. The line they went after was accounts receivable, one of the least glamorous entries in corporate accounting and one of the most useful if you want to lie. Accounts receivable is money a company has earned but hasn't collected yet. You did the work, you sent the invoice, the customer hasn't paid, it still counts as an asset and the sale behind it still counts toward revenue. Unlike cash sitting in a bank account, nobody can confirm it with a single phone call. Inflate receivables and two things happen at once. Revenue looks bigger, the balance sheet looks stronger. Lenders see a company owed a great deal of money by reliable customers. Investors see growth. The Justice Department announced the charges against both men in Manhattan federal court in 2021 in a case its release described as a scheme to defraud investors. The conduct laid out there ran from 2016 through 2019, 4 years of filings from a company whose stock anyone with a brokerage account could buy. There was a civil track running alongside it. The Securities and Exchange Commission sued Palleschi and Lethem in a parallel enforcement action. Accounting fraud works differently from a Ponzi scheme. There's no separate pool of victim money circulating in the dark. The fraud lives entirely inside documents that get filed publicly, audited annually, and read by people who are paid to read them carefully. Which sets up the only interesting question here. How does an asset overstated by 477% clear an annual audit at all, and how does the practice then run through 8 more quarters of public filings? Start with the worst year, 477%. Sit with what that ratio means. For roughly every dollar the company was genuinely owed, the books claimed close to 6. That isn't a disputed judgment call about when a contract gets recognized or a fight with the auditors about the timing of a milestone payment. At that ratio, the majority of the asset simply did not exist, and every downstream number inherits the lie. Revenue built on those invoices is overstated. Working capital is overstated. Any ratio a lender or an analyst runs off the balance sheet returns a flattering answer because the input was manufactured. This is also where receivables do their quietest work. Loan agreements are written against balance sheet figures. A covenant setting a floor under working capital or a ceiling on debt measured against assets gets tested using the numbers the borrower reports. Inflate the asset and the borrower passes those tests on paper while the underlying business does whatever it is actually doing. One line item restated honestly, and the company that appears in those filings stops existing. Then the pattern changes. 8 quarters, 8 overstatements. Every quarter of 2017 and every quarter of 2018, according to the Justice Department, carried an inflated receivables figure. The magnitude moves around inside that 18 to 120% band quarter to quarter, but the practice never takes a quarter off. That's the detail worth noticing. A single catastrophic year could theoretically be a collapse in controls, a company that lost the thread and then found it again. 2 full years of consecutive quarterly overstatements describe something maintained, and a quarterly report carries legal weight. It is a filing with the Securities and Exchange Commission, and the Justice Department charged Palleschi with making false statements in those filings as its own separate offense. Every 90 days, that report went out to the market. According to the Justice Department's sentencing release, Palleschi pleaded guilty in August 2023. The charge list is worth hearing in full because it maps the mechanics: conspiracy to commit securities and wire fraud, making false statements in filings with the Securities and Exchange Commission, improperly influencing the conduct of audits, securities fraud, wire fraud, and aggravated identity theft, 6 categories of conduct in a single plea, and one of them answers the question this whole story turns on. Improperly influencing the conduct of audits is a distinct federal offense. It sits apart from lying in the filings and apart again from the securities fraud count. It exists because a public company's numbers are only as good as the outside accountants who sign off on them. Those accountants are the control. They are the reason figures in a public filing are supposed to mean something more than what management wants them to mean. And the Justice Department's sentencing release describes exactly what that control ran into. FTE had recognized approximately $2.6 million as an account receivable with no support behind it. The auditors found it. They said the receivable should be written off. What happened next is the answer to the question this video opened with. For that same release, Palleschi and others created a fake email from a representative of the customer, saying the customer would expedite payments for more than $1.5 million for projects FTE completed in 2016 and 2017. The conspirators caused that fake email to be sent to FTE's auditors so that FTE could keep recognizing the receivable. That's the whole trick. An asset with nothing behind it stayed on the books because a message from a customer who never wrote it landed in the auditor's inbox at the moment the write-off was on the table. The email wasn't the only document manufactured for the accountants. The Justice Department's release says Palleschi and others provided FTE's accountants with fake convertible notes. Convertible notes are loans that can turn into company stock. They created fake board resolutions carrying forged directors' signatures, purporting to authorize those note issuances. They forged the signature of FTE's transfer agent on letters to lenders. And the release says they repeatedly lied to FTE's auditors, falsely denying that the company had issued convertible debt at all. So the answer to how the receivables survived an audit isn't a clever accounting theory. It's a paper factory running alongside the real books, aimed squarely at the people checking them. According to FTE's own 8K filing with the SEC, Lethem was sentenced first on May 13, 2025 in the Southern District of New York. He received 48 months in prison and 2 years of supervised release. The restitution number is precise. $10,894,561 to FTE, joint and several with Palleschi. Joint and several means the government can collect the full amount from either man, plus $2,100,000 to the company's shareholders. The filing says he was scheduled to report to prison on September 15, 2025. Note where that document came from. The company itself wrote the filing laying out what its former chief financial officer had been sentenced to. Palleschi was sentenced that September. The Justice Department's sentencing announcement says that on September 25, 2025, United States District Judge Colleen McMahon gave him 12 years in federal prison, followed by 3 years of supervised release. The same release puts the restitution at $13,541,707 and the forfeiture at just under $547,000. 12 years is a substantial sentence for accounting fraud. Lethem's sentence was 48 months. Palleschi's plea carried 6 categories of conduct including aggravated identity theft, and he ran the company whose filings carried the numbers. According to the Justice Department, Palleschi also embezzled corporate funds, taking personal trips on the company's private jet and issuing company stock without authorization. There's one more thread in this record and it starts with the same mechanic. Unauthorized share issuance shows up twice in FTE's history. The second time involves different people. FTE's filing treats this as a different fraud entirely. The company has its own shorthand for the two, the Palleschi and Lethem fraud and the Singal and Shkaradik fraud. FTE's filing states that on June 23, 2025, a jury in the Eastern District of California convicted Sunit Singal on 8 counts of mail and wire fraud. The SEC's own case against Singal over a different company entirely ended in a consent judgment in 2021, a civil penalty and a 10-year bar from the securities industry with a right to reapply. FTE's own filing says the company is in court seeking the return of shares connected to Single, shares the filing describes as fraudulently issued without FTE board approval to Single and to an entity called TTP8 in 2019. As of that filing, the case was still open, which leaves this. The two men who ran FTE are in federal prison, and the company they left behind is still filing with the SEC, still doing business, and still in court trying to get back stock it says was issued without its board's approval. A fraud this size ends in documents nobody reads, and I read them so you don't have to subscribe if you want the next one.